Okay, so good morning, everybody, and welcome to today's webinar where we're going to pick up where we left off last time, where we're going to teach you a price action trading strategy that's going to make you lots and lots and lots of money way into the future. I hope you've all had a good week in the markets and you've managed to make some good profits off of the volatility this week. There certainly was some volatility there. But the purpose of this webinar, as I said, is basically to kind of show you a strategy that's really going to serve you throughout the rest of your trading career. So it's not an analysis session today, it is an educational session, but one that you really should pay attention to because it's really going to put you in a good place. So last time we talked about the principles of trading, and we kind of went over some of the foundations. In this webinar here, we're going to get more into the detail of the technical stuff. So, the charts, how we go about analyzing the markets. Then as we progress through the webinars to come, obviously we'll get to the in-depth part of the trading strategies. And I promise you're going to love all of this. So, market conditions. The financial markets can trend, consolidate, or reverse. All right, if we can work out which one the market is doing, then we're already way ahead of the game. You see, what happens is a lot of new traders, they find a strategy that they like, and then they trade it blindly, which basically means if the market, let's say, for example, a trader finds a strategy that's a trend trading strategy, okay? They will trade that no matter what. So even if the market's in a consolidating range-bound market, they'll still try and buy breakouts and then wonder why they've been stopped out. So one of the keys to success in trading really is understanding what sort of a market are you in, because once you understand the market that you're in, then you know what sort of trading strategy you need to deploy to be able to make money, right? So if you can put context around your trading and not just trade every single setup blindly, then you're going to put yourself in a much better position to succeed in the markets than if you're one of these people that don't want to engage their brain and they just want some sort of a robot that just tells them exactly what to do and they take everything blindly. From my perspective, I don't think that that's a long-term recipe for success. Yes, if you happen to catch the market right, you can make some nice short-term profits, but market conditions always change. And if you're someone that's blind to it and you don't want to understand what it's actually doing, then you're going to find in the end, actually, you come unstuck. So, price for context. A trading system is important, but unless you know what sort of a market you're trading in, then unfortunately you can still fail. And this comes back to what I was saying just now about people, that new traders, they find a strategy and then they'll trade it no matter what the market condition is. What traders need to understand is that there's not just one time frame. So the market isn't just doing one thing. So let's say, for example, you look at a daily time frame. All right, and on the daily time frame, you can see that the market is really trending. All right, so you think that it's going in one particular direction, and then you jump down to, let's say, the 1 hour time frame, and from the 1 hour time frame, it looks like actually the market might be pulling back a little bit, and then you might go down to something like a 5-minute time frame to execute your trade, and in the 5-minute time frame, you can actually see that you're in a big downtrend. Right, so you need to understand that the market can be doing different things at different times, and you need to get an overall picture of the market to decide what the best course of action is. If the market's trending to the upside on a daily but trending to the downside on a 5-minute, it doesn't mean that you can't take a short trade on the 5-minute chart. It just means you need to pay attention to where the key levels are on the daily that it might turn around at. You see what I mean? So it's really just about engaging your brain and be willing to take a step back and take in more information than just the immediate trade that's there in front of you. All right. So one thing you need to understand is a trend on one time frame might be consolidation on another time frame and might be a pullback on another time frame. The location of your trade is also key to a successful trading strategy. You don't want to be one of these people that have just discovered a bullish engulfing candle, for example, and then you trade it everywhere on the charts. Because statistically, you're not going to have an edge if you trade like that. Statistically, you're going to have an edge if you take the bullish engulfing candles at strong support levels. Does it mean that you're going to win on every single trade? Absolutely not. Of course not. But by putting yourself in a position where you're taking high probability setups at high probability locations, you're definitely going to put yourself in a position to be able to make more money and grow your account in the long run than you would if you weren't willing to pay attention to that at all. All right? So you must learn to identify the market condition in order to have long-term success. I think this kind of goes without saying, but I don't think enough people really pay attention to it. Professionals, they deploy the right strategies for the right markets. Retail traders, they pick a strategy and then they trade that strategy no matter what happens. And you need to find your way into the professionals category as opposed to in the retail traders category. And that's got nothing to do with your account size, by the way. That can all be from a mindset perspective. So let's take a look at this chart here. This here is a 60-minute chart. Okay, now looking at this chart here, what direction would you say the market is going in? Hopefully, you're all sat there screaming, it's going down. You know, it's not a strong downtrend, but it's definitely a downtrend. So we look at that on a 60-minute chart. Fantastic. If we look at this on a 4-hour chart, that same price action, which was this downtrend over here, what are we looking at? Well, yes, we're looking at a bit of downwards momentum, but you're right smack bang in the middle of big consolidation. So if you were taking a trade down here, you can't sit there and turn around and wonder why it stopped you out afterwards, because ultimately you're going to be selling at a support level. If you didn't know that, so looking at the 1-hour chart then, you went to sell there, you would be selling into support and then you would lose money. So that's the 4-hour, so that's the 1-hour chart, downtrend. That's the 4-hour chart, it's going sideways. Now let's take a look at the daily chart. So the price action that we experienced, that we looked at, is this price action over here. So what is this? Well, on a daily chart, actually we just had a massive momentum move to the upside. It's gone from 118 up to 132, so like a 1400 pip move, and then it's pulled back again to 126. So it's pulled back 600 pips. But does that mean this is a downtrend? No. With that sort of momentum there, you have to be looking for buying opportunities. So hopefully you guys are starting to see that you have to pay attention to all of the different timeframes, because if you don't, you're going to find yourself in a position where you're taking trades into major levels that your trade kind of stands no real chance of success no matter what. Okay? So you have to take trade location into account. Not every single trade is created equal. Right? The location of a potential trade can tell you a lot about the probabilities of its outcome. If you're trying to sell the market and you're selling at a big time support, the probabilities of success are significantly lower than if you sold after the break or if you sold on a pullback to a resistance level. The trade location, it has to be used as kind of like a filter. Now, even if you don't use it as an entry, you use it as a filter to keep you out of the lower probability trades, to keep you out of the trades that aren't really going to make you money. You know, you don't take a trade if a trouble area is close by. You're not going to trade into levels. It makes absolutely no sense whatsoever. And yes, you may watch trades go by that would have made you a profit, but they are few and far between. Unfortunately, as human beings, we only pay attention to those because we're not in the market, and we sit there and think, oh, I could have been involved in that. I could have made money there. Damn it. But you didn't. So then the next one, you go and take that trade and it stops you out. And then the next one stops you out. Then you decide not to take that trade again. And you wait and you watch. Well, you decide, I'm not going to take this trade because it's into a trouble area. Then suddenly that one makes money. Just by fluke, by chance, not because you have an edge. And you have to remember that. So save yourself the money in the beginning. Don't get involved in those trades. We only want to be taking trades into fresh air. Okay, where there are very, very few trouble areas ahead, or if there are key levels, they're insignificant ones, i.e. we're trading on a 4-hour time frame, but the level is printed on a 5-minute time frame, something like that. All right. One of the major reasons that a lot of rookie traders fail is that they have a system and they only care about the system entries as opposed to taking the entire market picture into account. That's why they fail. Don't be one of those people. So another question I get asked is, how close is too close? All right. How much data should I have on my charts? Because we get emails from people who send us their charts in. Right? We get these on an almost daily basis saying, can you critique my trade? What went wrong here? And they'll send a screenshot of the chart, and there might be like 10, 20 candles on there, like nothing at all. And we'll be like, well, first of all, you can't see the entire picture here. You need to zoom out of your charts far enough that you can see what the price is doing, where the price is going. But you don't need to be so far that, you know, your trade perspective shifts. You don't want to be pulled so far out of the chart that actually you're not looking at the immediate price action. You're looking at a very, very, very long-term trend. You have to find a balance there. Now, there's no real scientific answer. That's why I always say that trading is as much an art as it is a science. It's something that you get with experience. But what I would say is that if you're looking at your charts, you need to have, you know, let me go over to a chart a minute, just so we can show you. All right. So you don't want to be zoomed in like this. I don't know what is going on by looking at this chart here. By the same token, it probably doesn't make sense to be zoomed out like that, because you may as well just go up a time frame, right? If we're zoomed out like this, yes, you can see a direction, but you're looking at a longer term direction. So what you need to be is you need to have roughly about this much data on your charts-ish. So this is a 4-hour chart, and I'm going back to about October of last year. So roughly about 6 months worth of data if you're on a 4-hour chart. If you're on a 1-hour chart, maybe you want 3 or 4 months worth of data. But you need to understand where it is that you're trading, where is it that the price is going in the immediate term future from your chart perspective. Does that make sense, everyone? Okay, I will get back to the presentation. So let's define a trend. Let's talk about what a trend is, because that's the first thing to understand as traders. Because if the market is trending, then we can expect the market to continue on to bigger and better levels. If the market's consolidating, then we know that trying to buy or sell a breakout is going to harm us. You see, you constantly hear rookie traders say things like, oh, breakouts don't work. You know, breakouts, they used to work, but they don't because there's not enough momentum in the market anymore. But actually, breakouts contribute a large proportion of our profits because we understand how to trade them, even if we don't understand how to spell, because I can see a typo on this page here. Even though we're illiterate with, you know, we can't spell and things like that, we're good with numbers. So the key is knowing when to take the breakouts and when to look for a bounce. That's what's going to define your success as a trader, okay? Now, to do this, as I just said, we have to learn to read the market condition. And this starts with understanding whether or not we're in a trending environment or whether we're in a consolidating environment. Now, from a technical perspective, a trend is a series of peaks and valleys in the market that are moving in one particular direction. An uptrend is characterized by a series of higher highs and higher lows, and a downtrend is characterized by a series of lower highs and lower lows. Knowing the market condition is extremely important for us to make money trading. In a trend, we want to be trading in the overall direction of the trend, because let's be honest, none of us here have enough money to move the markets. All right, we don't have enough money to affect the markets like that. But what we can do is we can figure out who it is that does have that influence over the market and which way they're looking to trade. And then we can jump in on that trade. All right. In a range-bound market, we want to be buying bottoms and selling tops. If the market's moving sideways, then we're not expecting a breakout. Yes, a breakout will happen at some point, but the money is going to be made trading the range. The market has a structure to it. It allows us to identify the trend, all right, in any market, or the consolidation. And that's what's great about using charts. It kind of gives us a visual aid to help us make our trading decisions. Now, that's not to say that you don't need to use fundamentals, or you don't have to use fundamentals, rather. All right. If you want to use them, by all means, use them. They will increase your strike rate. But if you don't want to use them, you can still make money by using the charts. All right, knowing the direction of the trend allows us to take higher probability setups, knowing the market condition. Now, one of the things that we use to define the trend, or to give us, actually define the trend is the wrong word, to kind of give us an idea, an overview, just by looking at the charts and, like, you know, split second, be able to look at a chart and decide which way the momentum is we throw a 100 exponential moving average on some of our charts. And the simple rule is that if price is above the moving average, then we're bullish. We want to be looking for buying opportunities. If it's below the moving average, then we're bearish. We're looking for selling opportunities. That's the way that it works. It's not to say that you trade based on a cross of a moving average. That would be silly. All right, it just gives us an indication of where the price is moving, and then we can take our trade based on price action. So a question that I get asked when we're delivering our seminars, when we do our courses, is, in an uptrend, what's more important, the higher highs or the higher lows? What is it that you look for? So because in an uptrend, you're still going to see periods of consolidation. So what is it important that it holds? Is it important that the market kind of meanders up and keeps pushing new highs? Or is it more important that the lows that the market make, the support levels that the market makes, are held in place? Well, from my perspective, in an uptrend, it's the higher lows or the structure lows that hold the trend in place. All right. And a downtrend, it's the lower highs. All right. Or the structure highs that hold a trend in place. Now, why is that? Let me explain this a little bit. You see, when the market is moving up, in fact, let's go back over to a chart for a second. Let's find a trending chart. All right. Onto the daily here. What I want to see, right, as the market is moving, in fact, this is just one direction, so it's quite hard to show, but I'll try and give you an indication here anyway. As the market is moving down, right, moving down like this, all of the major levels, put a crosshair in there, all of the major levels we want to see held in place. So this is a downtrend. So what I would want to see are the highs, so this one over here, being respected. If it's not respected, then I need to start questioning. This is sort of like my line in the sand. So when the market broke out above this level here, that was my signal to say I don't want to be shorting above there. Now, I don't necessarily want to be long, but I'm certainly neutral at this moment in time. All right, if the market then manages to close back beneath this level and respect this resistance level there, then that's an indication that the market is going to continue on its downtrend, which it did. So eventually it broke back below here. You could have had an entry on the chart at around that area there. Similar sort of thing here. Once the market comes down, we want to make sure that the previous swing high is held in place. So this previous high over here, the market comes down, pulls back somewhat, attempts to get up there, but immediately gets rejected. Now, this is kind of a bad example because this is Brexit back here. We decided to exit Europe at that point. Oops. But hopefully you can kind of see what it is that I'm referring to. Let's take another chart. Let's go to the Euro Aussie. Okay, so the Euro Aussie, we've got here, it's in a downtrend, although a pretty poor downtrend. The market's still moving down. Notice how it's not breaking to new lows there, but that's not what's important. What's important is that the highs are being respected, right? So if we were to, hold on, let's get a pen in here. So if we look at that high there, make this thicker. No, all right. That high there, that high there, that high there. What we can see is this high is lower than that high, this high is lower than that high. So this structure is being held in place. And as long as that structure is being held in place, then we're still going to be looking for selling opportunities. Okay, obviously, if it goes on for too long, then you'd come to the conclusion that actually you're in a consolidation as opposed to a downtrend. But all the same, if someone held a gun to your head and said you have to trade in a particular direction, you would trade to the downside as long as these highs are held in place. That makes sense? No questions? All right. So once you're able to define a trending or ranging market and you can start to see the structure in the markets, you can then use the key levels and support and resistance to build a trading system. Okay, I keep going over to the charts too soon, but let's go back over to the charts anyway, just so I can show you what a trend looks like. So let's go over some charts and try to define some trends. So looking at the Aussie CAD, what would you say is going on here? Let's focus on the 4-hour chart. If you had to pick a direction, what would you say was going on here? Trend to the upside, right? So the market is moving, it's swinging up, it's swinging down, it's swinging up, swinging down, it's swinging up. And every time it swings up, it's going on to a new high. And every time it swings down, it's respecting the previous low. So that to us is a technical uptrend. What about CAD-Yen? Looking at this chart here, what would we say is going on? You'd have to say a downtrend. You'd have to say a downtrend. Look at this. All of the highs are lower than the previous one. And the lows gradually are getting lower than the previous ones. So you're on a downtrend. You'd be looking for selling opportunities. I know a lot of you are probably watching this thinking, I know what support and resistance is. I know how to define a trend. Why would I watch this? It's never bad to go back over the foundations, over the fundamentals, just to make sure that your understanding is correct. Maybe get somebody else's point of view of things. Maybe it's different to what your perspective is on things. So if you are watching this and you are thinking, I know all of this, bear with me, I promise you. By the time we get to the strategies, you're going to thank me that you've sat in on these webinars. So hopefully we get a bit of an idea as to how to define a trend. All right, so now what I want to do is talk about support and resistance and key levels, which to me is probably one of the most important tools you as a trader could have in your toolbox. So what is support and resistance? Well, it's a form of technical analysis. And what's technical analysis? Well, to me, my definition is technical analysis is a study of the charts to identify high probability trading opportunities. All right. And support and resistance is the most basic, yet the most effective form of technical analysis. Most market participants out there acknowledge that these levels exist. You know, I've got friends that work for big hedge funds and big banks. They all look at support and resistance levels in one way or another. They may answer slightly differently, but they all look at them. So if they look at them, then we should be looking at them as well. And why should we be looking at them? Well, it will give us an indication of where we can take our trades from. So we don't have to be sat in front of the screen every day hoping to find an opportunity. We can put in our levels, we can walk away, and we can come back and execute only if the price gets to that level. So what is support and resistance? Well, support is an area where sellers find buyers. So if you imagine the market's been moving down, and as it moves down, it comes to an area where it can't go any further. And then it goes in the opposite direction, it starts going up. That's what's known as a support level. A resistance level is a level where the buyers find the sellers. Okay? So the market will have been moving up, it will have been rallying, and then suddenly it hits a wall that it can't get past. So it's been moving to the upside, it gets to this place where it can't get past, and then it falls away. And what that is, that's the sellers in the market taking over. Does this make sense? The levels on a longer term time frame are more important than levels on a shorter time frame. So if you were looking at levels on a 5-minute time frame, it's not to say it won't work, it just means that if you've got a level on a daily time frame, that is going to trump the one on the 5-minute time frame, because that's going to have more effect on the rest of the market. So why do we like support and resistance? What can they do for us? What can they do for our trading that's going to improve our trading? Well, we like them because price reacts to these levels. So movement can be anticipated at these levels, which is what I just said to you. You're not going to find yourself in a position where you're sat there in front of your screens all day long waiting for the market to get there, only for nothing to happen. You literally just go away. You can set orders in at these levels and enter when the price gets to the order. Support and resistance levels are ideal for entries and exits. Okay, so we can get in at these levels and we can get out of these levels. Get out of these levels. What is he talking about? What I mean is that if you're in a trade, you can choose to exit your position, part or all of your position, at the next key level, because we know that price reacts to these levels. So it's going to do one of two things. It's going to either break through this level or it's going to reverse at the level. And because we've already made money, we can exit for a profit when price hits this level to avoid getting taken out if it reverses there. Does that make sense? So how do we draw in our support and resistance levels? Well, unfortunately, we can kind of only do it after the fact to an extent. So the first time a support or a resistance level is printed, the very, very first time, we have no way of doing that. I have no way of identifying that or knowing it. We have to wait until it's been identified, and then the next time the price comes to the level, then we can trade it. So this is a resistance level. It's, as I said, it's a ceiling where buyers find sellers. Market pulls back, breaks through it eventually. Printing what? A support level. Okay? Market then pulls back, creating another resistance level. So you're starting to see how these levels look. The market over here was rallying up, pulled back a little bit, and then printed a resistance level. It then turned around at this level and started to rally. And then sold off from the level, came down to this level. So this is resistance, this is support, this is resistance, right? What's happened here? This is a level of resistance, and this is a very, very important concept. One of my favorite, maybe. And that's previous resistance becomes support, or previous support becomes resistance. So what happens is the market, although the market broke through this level, doesn't mean that now that level is of no relevance to us. Quite the opposite. Now we can anticipate where price may move around at, where it may turn around. Because it obviously has something in for this level over here, the next time price approaches it, it's not going to just ignore it. Well, most of the time it's not going to. And then you can trade based on that. Okay? So you're going to hear us talk about key levels. If you watch my videos, if you follow me on YouTube, if you watch any of the analysis, you'll hear us talk about key levels all of the time. Key levels are major support and resistance levels that price interacts with over and over and over again. They're horizontal lines on your chart, like I just showed you. Levels on the higher time frame tend to be way more significant than those on the lower time frame. And we know, and we've discovered from looking at the charts, that they trigger volatility. So breaking that level can add momentum to a trade, or the level can act as a catalyst for a trend reversal, or just initiate a pullback. But something will happen at these levels. These key levels, they're where the big money will affect the market. So major stops are placed on the other side of these levels. Buyers and sellers use these as reference points. And because we know all of this, it provides us opportunities. Opportunities to make money, opportunities to get involved in the market, and opportunities to not lose any money. Hopefully you're all starting to see how important these are. What I want to do is I want to show you how we identify these levels in the markets, okay? So let's take a chart that I haven't already marked up. Let's take up an oil chart, for example. So you've got crude oil here. Make sure no questions are coming along. We've got crude oil here. So what constitutes a support or a resistance level? Let's get rid of that. It needs to be major levels. They can't be levels where you're squinting, okay? So for example, this sort of stuff here, this is not a level over here, because that's not really a support or resistance level. That's the price just doing what the price does. We want the price to have a reaction. So we want it to come up to a level, then sell off from it. So here, for example, this would be a resistance level. Down here, this would be a support level. Okay? That would be a support level. Move that up somewhat. That is a resistance level, there's no doubt. That is a support level. As a resistance level. So hopefully what you can see here is I'm only marking up the major levels on my chart. Let's take everything that moves. I just want the biggest levels to give me a clue on the direction of things. Is this making sense to you? What you don't want to be doing is trying to turn your computer on its head just trying to pick out levels. They have to be obvious. But what happens when they're obvious? Take a look at this. Take a look. So this level over here, okay? Right here at around the 49 level. That was a high back in 2016, August 2016. Breaks through it. Comes back to it. Where does it turn around? At that same 49 level. And where is this? 3 months later, more or less. So one was printed in August. And then in the November, we can see that the market comes right back directly to this level and turns around at this level. It's not an accident, guys. You know, even this over here, this little sideways price action, it's not an accident. It's not surprising the price came down here and went sideways for a bit, because it was a big level in the past. So the market's going to pay attention to it. Even if it breaks through it, eventually it will still pay attention to it. Okay, so the key to creating these levels is not to squint. If you try and look too hard, it's not there. Really, really is as simple as that. Okay? So the things we've talked about in this webinar here. We've talked about the market condition today. Hi, Tom. Hi, Albert. We've talked about the market condition. We've talked about what is a trend, defining a trend, why it's important to understand if we're in a trending market or if we're in a range-bound market, if it's moving sideways. We then talked about support and resistance level, and now we've just put them up on the chart and we've talked about key levels. This stuff is powerful stuff. We haven't even got to the strategy. And I'll tell you something, the strategy, when we get to that, hopefully on the next webinar, if not that one, then the one after, the strategy is absolutely flaming phenomenal. It really, really is. I don't think you're going to find anything else like it out there. The strike rate is just ridiculous. But it's all based on these foundations. If you don't understand these foundations, and these fundamentals, then you're not going to be successful in the long run. Does that make sense? Are there any questions? We've got a few minutes before we have to wrap this up. So I don't want to go on to the next topic. I'm going to save that for the next webinar. But are there any questions at the moment about what you've seen today? So market condition, the trend, or support and resistance? No questions? This means one of two things. Either I'm the absolute best teacher in the world, best educator you've ever heard of. I articulate things so well that you don't need to ask any questions because I've already read your mind and already answered all of the questions. Or the other alternative, which is you're thoroughly confused. And actually, of everything that I've said over the past 40 minutes, none of it makes any sense. So you don't even know where to start asking questions. Which one is it, people? Make me feel better about my life and say that I'm the best. Or stay silent. The silence is deafening in here. Okay then, people, if there are no other questions, let's wrap it up here then. No one's got anything to ask. I'd like to thank you all for joining, obviously. Thank you for joining us today. Thank you, FX Street, as always, for hosting these things and putting on these great webinars. I think everybody learns a lot from them, which is fantastic. And I will look forward to speaking to you all on the next webinar. Okay, where we're going to start talking about the strategies. We've been laying the foundations, talking about the fundamentals, which is great. But let's now start looking at the strategies. How do you make money from this? But don't, if you don't understand this, don't skip it. Go back and watch it again because it is important stuff. Okay? So thank you very much, everybody, for joining. I hope you have a wonderful, wonderful end to your week. I hope you make loads of pips worth of profit, and I'll speak to you all soon. So take care now and have a good day.